Phil Streible, Chief Market Strategist at Blue Line Futures, is back with us to talk about Fed meeting this week. The Fed has kept rates near zero without changing anything, to nobody's surprise. Are you surprised, Phil? Welcome back, by the way.
Yeah, thanks for having me. No, this is actually supposed to be one of the last meetings where we don't have any real fireworks involved. So everything was basically discussed the way that it was laid out and the way it was presented by Jerome Powell. Even his testimony after was in line with what all the analysts' expectations were. Just keep the pace, watch the recovery.
One thing he did say, where the Federal Reserve did, the FOMC did issue as a statement, is that, and I'm just going to read their quote here: amid progress on vaccinations and strong policy support, indicators of economic activity and employment have strengthened. So that is more or less an upgrade in tone in terms of their economic outlook. Do you agree with this outlook? Do you think that the economy is recovering at a pace that's acceptable?
Well, yeah, and we're seeing it. It's completely in line with number of vaccinations that occur, because you're starting to see employers bring people back into the office. And as that happens, you'll see the economy, it has a trickle effect. You know, if you're leaving your house to drive to the office, you're stopping at a store, you're filling up gas, you're starting to consume products. And, that's the reason why you'll see a ripple effect on the economy. Now, there are some businesses that are just never going to come back, or some industries that are completely crippled right now. So those are going to take multiple years. So that's why they're being very delicate in any kind of moves, policy moves.
The 10-year Treasury yield has trickled up this week. It's fallen somewhat today following the start of the meeting, but it's still hovering at about 1.6, above 1.6. And so, Phil, my question is, should the economy recover at a pace that's in the Fed's eyes acceptable? Should it not hold that the 10-year yield would strengthen even more, and would that bring any risks to the equity side?
Yeah, unfortunately, that yields are going to continue to rise, and we should see a breakout over 172 to 178 on 10-year. And then I think ultimately we're going to end up just over 2%. So that is going to act as a headwind in a lot of different areas of the market. It'll also act as a headwind on gold. So gold really needs some other catalysts in order to drive it higher at the moment. Otherwise, you're probably going to see some downward pressure.
Yeah, we're going to touch on gold in just a bit. The other part of the economy that's an important indicator for the gold price is inflation. Now, it's common to believe that with rising inflation, the 10-year yield would rise, as you've said. So I wonder how much inflation could possibly rise in the face of rising vaccinations and improving economic conditions. Do you see inflation going above 2% this year?
Yeah, I believe it will. I mean, the inflation's here. It's in all these other products. I mean, now you're starting to hear everyone talk about, lumber prices, ethanol, hogs, gasoline. All these commodities are up over 50% year to date. And the issue is that so those are growth related items, commodities that go up in rising growth and rising inflation. Now, gold goes up when you have the rising inflation, but you don't have the growth aspect of it. So people are chasing all these other commodities. So that's really a stagflation environment. That's when gold actually performs its best.
We still have a very high unemployment rate compared to historical standards. We still have millions unemployed. So given that we have inflation in the raw commodities and perhaps consumer goods, do you think wages would improve to outpace inflation this year? Is that possible?
We will start watching the wage growth numbers. Those are paired with the jobs number, the payroll numbers that come out first Friday of every month. There are a lot of initiatives to raise, minimum wages, and these costs are going to continue to go up. So I think wage growth has to mirror, the rising inflation. There's no telling, if they're going to be able to pass some of these policies and these bills. And Biden's doing a good job trying to get this infrastructure bill pushed on through. So I think all these have a trickle effect on creating more jobs, creating that wage growth.
Okay, so let's put the two variables together now: inflation and nominal interest rates. So talk about real interest rates now, Phil. Real interest rates is one of the defining variables for gold. So do you think,
real rates have been starting to rise, and they're going to continue to move on up, and that is the problem. That's a headwind for gold. I'm a long-term believer in gold and silver, and multi decades. They continue to go up. So I think that the corrections in gold are shallower, like sub $1,000 gold. That probably won't exist anymore. Silver in the high teens. That would be a real rare occurrence. I think if we get down there, I think the demand is too big. So I think that there's new bracketed levels that gold and silver are trading at. 1,400 seems probably too cheap on gold. $22 on silver. That's probably a good value zone for long-term accumulation and holding.
Okay. So short term, you see major headwinds for gold. What about for silver?
No, silver, I think it's got to break apart. I mean, you look at some of these others, you cannot, deny the strength that's in palladium and copper, platinum. Platinum's doing great. Every time it dips below 1,200, we start to accumulate some contracts down there. And we shoot them out when they go up over 1,200. We trade the futures contracts, are highly liquid, trade almost 24 hours a day. So this is not a buy and hold type strategy. This is you trying to tactically trade those markets. So we look at corrections as an opportunity to accumulate, and then on these green shoots, we look at it as an opportunity to sell out.
The equities markets are flat today, or down to flat. The Dow is down right now as we speak, about 30 basis points. The S&P 500 is flat. So markets are not, well, the equities markets at least, are not really reacting to Fed news very much. Do you see major headwinds for the equity side, and could that provide some tailwinds for gold?
Yeah, equities will have a struggle in the back half. So you're seeing like a lot of companies are coming out and they are having explosive earnings, record earnings,
Yes.
Because of the fact that they're going from such low levels that year over year comps are going to blow out the water. The problem is forward guidance will start to compress. Anyone who's bought some of this technical equipment that we're using right now at the pandemic lows, when everything was basically work at home, those types of stocks will face headwinds on year over year comps and quarter over quarter. So what we've been doing for the equities is we've been buying a broken butterfly, put butterfly for the September contract. So we've been buying like 41.50, 4,000, and then it'll be broken. So it'll be like a 39.20. And we're playing that for a sell-off in the back half of the year. That's where gold really gets its second leg up. So, hopefully gold can have a correction and we can accumulate back closer to that 1,700 level.
So you said equities could have a correction in the back half of the year. Is there a level you're looking for? How much higher could we run up before this correction occurs?
No, I mean, people throw out all kinds of price targets, 42, 4,300 on the S&P, so it's difficult with a price target, and difficult with, the situation that we're seeing in equities is every time they have a breakdown, there's a panic sell, and people literally sell out, like race to the door, that they think that was the top of the market, and then what they do is they chase going up, and that's how the equities make new all-time highs. So we're continuing to see that cycle, and we're going to see that emotional fear of missing out until about June, and then when we get in the second half, I think that some of these stocks will start to break, and then the recovery will be I don't think we're going to crash, but I think that we'll have a systematic correction.
Here's a risk that I see, and let me know if you don't think this is substantial, but it's possible, I think, that the economic recovery could happen much faster or at a stronger pace than expected, and so the Fed could be forced to taper off on their easy monetary policy later in the year. Do you think that's possible?
Next meeting, you'll start to hear about tapering, and there is some wide speculation on like when they're going to finally raise rates. It's like December 2022 and then March 2023. That's when it's kind of two different products are pricing in rate hikes at that level. I think that Jerome Powell, he's definitely not going to try and cripple the recovery. At least they're going to wait until they got the herd mentality. Most of the people are going back to work, and then at that point is when they'll start tapering off. And that taper effect there's no telling how it's going to impact the metals because I think that equities will start to decline, that growth will compress, inflation will still be here. That's where your gold starts to get another boost.
Okay, and bonds now, then, given this story, would you like treasuries and fixed income?
Well, not until again that second half. So we've been doing things with the treasuries where we're selling like a call spread on the June treasury, the 10-year note, and then we're using the money to buy a put spread. And we've been doing that for quite a while. It's got defined risk, and I think that we're going to get that gear up in yields, especially in this second quarter.
Finally, are you still bullish on oil? I remember we spoke about this last time. Oil's up today, actually.
We took a lot of oil off today, and it was a great trade. We were selling a put spread to buy a call spread. These things, they sound complicated, but they're really not. And we were purchasing a lot of oil in the high 50s. It was the fourth time we've been in oil since about November. I like oil to the upside. A lot of geopolitical tensions going on.
Yeah.
And, OPEC already came out, reaffirmed that they're not going to try and flood the market with excess oil. So, oil's a good trade. Again, I think below 60, I think it's a good buy and hold. You start getting north of 65, might get a little top heavy. So we're really trading a lot of these markets. Another market that we got an eye on is Australian dollar. It's commodity-based currency, tracks the metals, the miners. It's agricultural markets going up, inverse the dollar. We think the dollar will have another leg lower. So one other thing I'd point out is that the inverse correlation is about 0.8%. Dollar versus gold. So, it does have that inverse correlation going on.
If you like the Australian dollar, you might like the Canadian dollar as well then?
Yeah, the only problem with Canada is that you've got, they've had some COVID issues recently, and that's caused some problems. So we're keeping an eye on really COVID. We're keeping an eye on India. We saw big moves in sugar market because India's got a really bad problem right now. They're completely locked down. So how are they going to harvest sugar and things like that? So we really look at trying to identify different things with commodities that are impacted by these countries.
So of all these commodities and trading vehicles we've discussed today, it seems to me like your outlook for the first half of the year or the remainder of the first half of the year is different than the outlook for the remaining half of the year, right? Is there one asset that you would be consistently bullish on?
So we've converted more towards trading like options, calculated risk strategies, and things like that. As you get near a lot of these commodities being at all-time highs or near it or retesting it, because of the fact we don't want to be holding the bag if the correction happens sooner. What's going to set it off? I'm not sure, but there's, this is where risk management comes into play and choosing the right strategy to be involved with. You don't want to be dollar cost averaging and the market starts to go in a decline and it's not going to come back because you need an event to get you back to all-time highs in order to do it. And I don't know what that will be.
Okay, fantastic. Phil, thank you very much for your update today. It was a pleasure as always.
Yeah, you have a great day.
You too. Thank you for watching Kitco News. Don't forget to subscribe if you're watching on YouTube.